Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
And back again. Like it or not. I like it. There are an awful lot of good things happening. It sounds like a government's actually doing some really interesting things. Many of them are going to be fairly beneficial for the economy. So that's kind of cool. It's amazing. A lot of people are worried about this president because, he says a lot of things that he retracts fairly quickly, which is a good thing, I think. If you're going to say things that occasionally don't make a whole lot of sense, might as well retract them. But he's the most watched president in the history of the country. Not just because of his personality, it's because we can. Because we have Twitter, which, by the way, he is a big participant of. We have the internet. There's whitehouse.gov. There's so many companies out there, or organizations anyway, that are watching and tracking and looking at it. And I think it's a good thing that they're watching. And I think I've said this a million times. President's really like a quarterback of a football team. They get too much credit when they win, and they take too much blame when they don't. So without the supporting teammates, you can't do very well. You're not going to do very well. In fact, ask the Browns how that works. Browns have had some pretty good quarterbacks here. None of them last, and a lot of people don't think they are that good. And reality is they don't have the rest of the supporting cast, and hopefully one day, that'll change. But anyway, so like what I'm seeing, bonds, wow, man, bonds have really sold off. It's really interesting. And you look at short-term treasuries are actually down. If you look, they peaked last July. So short-term treasuries are down about 1.2% over that time period. So if you reinvested the income that you were getting, you're down about 0.5% or so on short-term treasuries. Right? That's amazing. Go out to the longer-term treasuries, and those peaked right around the same time, around July, August last year. Long-term treasuries are down 18%. And because their dividend yield was so low, you're still down about 16% in U.S. government-guaranteed bonds. Why does it work that way? Well, we'll come back to that, but interest rates, it's the expectation of interest rates. Interest rates are not as high as would warrant that type of a drop. Does that mean they're going to bounce? I don't know. Nobody knows, actually, not for sure anyway. Economy's improving. Look at this morning's Wall Street Journal. We're adding jobs at a pace that's faster, and the unemployment rate is reaching a level that it hadn't reached since before the big recession. Wage growth is starting to increase. Those are all good things, by the way. Those are good things for the stock market. And since I mentioned that, I should probably tell you that the seminar this Thursday is almost completely booked. Which is very interesting. A lot of people coming. It's going to be. I think this is the perfect time to do what I'm doing right now. I think the high dividend model that I run, we're going to go through that again, 5 minutes, give you the highlights, show you how it's done, why I think it still makes a sense for a part of your portfolio. But I have built another model that I think also makes an awful lot of sense for a portion of somebody's portfolio. And here's what I did. Because the high dividend model has done so well over the past couple of years, and valuations are not as good as they once were, meaning that share prices have gone up, even though we're rebalancing and buying, companies that have gone down whose dividend yields are now higher. Even with that, the dividend yield on that is the lowest it's been in about 3 years. It's the lowest it's been in about 3 years. The dividend yield on that portfolio, by the way, is still above 4%. So when you compare that to the other, like the ETFs that are out there, that are dividend-paying stocks and whatnot, the dividend yield on this one's almost twice what the dividend yield on those are. So it's one of the reasons I like it. It's one of the reasons it tends to bounce back faster from a decline. And we'll cover all that stuff on Thursday. It should be a lot of fun. But there are a couple of areas in the stock market that have not participated in the move of the S&P 500 or the Russell 3000 for that matter, because those are market cap weighted or market value weighted indices. And we're going to go into that. I'm going to spend 5 minutes talking about that. I'll probably spend 5 minutes talking about that on every show, because the concept is a little difficult for some people to understand. And for those of you that get it right away, I apologize. I'm going to have to take 5 minutes every week and go over this again. But you know what? That's actually not even a bad thing. Reviewing the basics, the fundamentals, that's a good thing. Keeping your mind set proper for being successful in the investing markets, especially the stock market, is key. It's 95% of why you'll be successful. It's going to be because of the attitude that you carry. And the attitude is improved when you have knowledge. It's improved. The more knowledge you have, and then you gain experience, now you've got wisdom. That's wisdom is the combination of knowledge and experience with an open mind you. So, again, we'll be talking about this probably every show. And here's what a market cap weighted or a market value weighted index fund is. The S&P 500, Russell 1000, Russell 3000, Russell 2000. These are methods of selecting stocks based on size. That's the primary factor, is size. Another primary factor is that they're all traded on a U.S. stock exchange. Most of them are U.S. companies. So we're looking at size. And a market value weighted index like the S&P 500 will put more money in Microsoft when it's $200 billion, because at $200 billion, it's a lot bigger than the smaller companies. And you know what? Next week, I'm going to actually pull up all the companies and show the differences of the holdings that are in there at this point in time. So for today, I'm just going to finish with this little explanation, then we'll move on. And by the way, feel free to call with any questions you have, 216-901-0945, 216-901-0945. And a market value weighted index fund puts more money in Microsoft when it's $200 billion as a percentage of the assets in the fund. So if Microsoft made up 3 or 4% of the index, that's how much money they're going to put into it. 3 or 4% of all the money in that fund is going to go into that one stock. Now, that'd be great if you only had 30 stocks. 30 times 3%, you got 90% invested in 30 stocks. But you've got 500 stocks. You put 3% into one stock. That means a lot of the smaller, faster growing companies are going to get a much smaller percentage of that money. So that's one of the drawbacks to investing in a market value weighted or a market cap weighted like the S&P 500. You're going to put more money into companies after they've gotten bigger than you would have when they were smaller and growing faster, and their potential is much larger. So that's one of the things I'm not a real big fan of investing that way. Now, if I had $100 billion, or if I had $1 billion, I probably wouldn't have a choice, because quite frankly, there just aren't that many stocks that you can buy and get a decent diversification with when you're running $1 billion. There aren't that many. There are only a little bit over 3,000 stocks for them to choose from today. That's it. That is 99% of the U.S. stock market, which makes up about half of the stock market value of the entire world. Never mind that, they're close to 200 countries and we're only one. So one country out of close to 200 countries makes up 50% of the stock market value. Go figure that out. I'll tell you what it is. It's having a Federal Reserve System and capitalism. That's how we got there. Anyway, I do this to myself all the time. I lose my train of thought. Market cap weighting. So if I had billions, yes, I want to invest that way. I don't have billions. I will probably never be a billionaire unless I win a $1 billion lottery. So I don't have to invest that way. Not necessary. I'd rather do something a little bit different. I don't want to put more money in Microsoft when it's $200 billion than I want to put in it when it's $2 billion. That doesn't sound good to me. Okay. Now, if you want to do that, that's up to you. And I hear people, repeating this, and it's been repeated so much that, and by so many people, and there's so many misrepresentations of the data, or maybe not even misrepresentation. Let me give them the benefit of the doubt. They just don't know any better. They look at statistics that and I'm pretty sure a lot of people that print this stuff don't even go take the time to verify the data, because the data is coming from trusted sources. Same way that trusted sources led people to believe that there were AAA bonds out there that, turned out not to be AAA rated. Yeah. Anyway, and it's the same sources of data. That's the one that's really killing me. So they're not bothering to verify. And because you know what? It's hard. It's a lot of effort. It takes a lot of time to verify that stuff. Anyway, so if you're a billionaire, yeah, market cap weighting is probably okay. Probably fine. You're a billionaire. What do you care? If you got $1 billion, that's 1,000 million. 1% of 1,000 million is $10 million a year. So your dividend is $10 million. Yeah, you can afford to invest that way. If you're one of the average Americans that needs to take money out of their account to supplement their income in retirement, probably not the best idea. Why am I saying that? If it does well, and it does do well, actually that strategy does very well if you give it a long enough time period. Here's what I mean about a long enough time period. In March of 2000, S&P 500 was right around 1,500, right before it dropped 50%. Then in 2007, near the end of the year, it actually got back to that level again, got right around 1,500, 1,540, somewhere in that neighborhood. And then it dropped further than it did the first time. Went down 57%. And then finally, in 2013, the price gets back up. Now, if you were reinvesting the dividends, you only had a 12-year period where you didn't make any money. Let me say that again. If you were reinvesting the dividends, you only had a 12-year period where you did not make any money. If your timing was like mine is, I'm born when I retire, the market's going to decline. So that's why I'm not going to retire. I'm just going to keep working because I know the market would do that. 1987, my luck would have been, in October, right before the 20% drop one day. I would have retired the day before that. And, so somebody out there with luck as bad as mine had retired that day. Anyway, so I can't afford a 12-year period without making any money. I don't care what the long-term performance is. I can't afford that, and probably neither can you. So if that doesn't sound good to you, then you need to look for alternatives. And those are the alternatives that we're talking about. We always talk about at all the workshops that I do. In fact, this workshop is on Ben Graham. If you don't know who he is, he was actually extremely influential on Warren Buffett. He was his graduate school teacher and his first employer, or one of his first employers. Worked for his dad, actually, before that. He had to pester Ben Graham to give him a job. And Ben Graham was a money manager and a Columbia professor. And he taught classes on investing, value investing. And a lot of the principles that he taught way back then, they still hold up today. And there are ways of doing them. And there are ways that I think some steps you can take using some of those concepts that he set forth to try to avoid having the 12-year negative return. And that's what we're talking about at this workshop. I have a couple models. The dividend model that I run that a lot of my clients are already familiar with is a variation on the theme that Ben Graham taught. It's a variation on the theme. I just modernized it just a little bit. And I am absolutely sure that he would approve of it. I know he would. In fact, the long-term track record on that's close to the long-term track record that he had. And he had the advantage of nobody knowing what he was doing. So that's a big advantage, by the way. When you're managing a fairly significant amount of money and people know what you're doing, they tend to try to jump in front of you before you buy, driving your prices up. They find out you're selling, they're going to sell it first and driving the prices down. It makes it more difficult. That's why billion-dollar funds have such a hard time. Well, that's actually one of the reasons they have such a hard time keeping up with the S&P 500. But you as an individual, you don't have those problems. You don't have to worry about managing billions of dollars. No. And if you do, and you're worried about it, give me a call. $1 billion client, that would be awesome. But we would actually be forced into, and even then, by the way, when you're $1 billion client, there are other ways. It's called weighting based on fundamentals. That's a future workshop. This workshop, we're going to be talking about some things that we can do, some things I'm able to do with a custodian, some things that Fidelity's got some platforms now that are relatively new. We've got one coming up in June. I think they're going to offer some of these alternatives. And it's kind of a big deal. It's a big deal to have alternatives that are not saying I'm going to put more of my money in Microsoft when it's $200 billion than I did when it was $2 billion. And if you do some of these other ideas and it only adds a couple percent, you do a couple percent over a 20-year time period, you end up with 50% more money. So if you would have ended up with $2 million, now you're going to end up with $3 million. One simple change. How cool is that? And it's just from knowing this stuff. And you don't have to be a financial genius, by the way. You do not have to be a financial genius. You do have to know the basics on financial statement analysis if you want to do it yourself. Okay? If you want to take the time to do it yourself, you're going to have to know the basics. And obviously, the more you know, the more the odds start to fall in your favor. But I'm going to show you the things that you definitely need to know at that workshop. Now that you hear the music, that means I got to take a real quick commercial break. You listen to Bill Bullington right here on 1420 The Answer. I'll be right back. And we're back. Wow, I almost blew my own ears out there. Hey, if you'd like to call us, 216-901-0945, 216-901-0945. So, we were talking a little bit about market cap weighting, the effects of that. One of the other side effects of market cap weighting is it does lead to bubbles. What's a bubble? Bubble is when share prices on something go up and get so high that eventually it's going to crash. That's what a bubble is. And there are lots of bubbles. They form sometimes, most of the time, they're relatively small. They're in one or two areas. Like, if I think back, the nearest time that happened was probably 2010, 11, and it was in biotechnology stocks. A lot of the stocks that didn't have products yet, didn't have any approval, had no revenues, were flying. They were going up enormously on the expectation that they would develop products and be able to sell them and make lots of profits. So it was the expectation, and that's what it always is, incidentally. It's expectations. That's what causes bubble. Well, I shouldn't say that's what always is. It's one of the causes of bubbles. Expectations are very, very high. Got a couple of stocks to talk about where expectations are really high later on in today's program, right before the last section of the program. And I'm also going to give you some names of some stocks that have been coming up on scans that I think have a good chance of moving higher relatively quickly. And that's another style completely, by the way, from Ben Graham, Warren Buffett. There are two major styles. One of them is value-oriented. That's the more popular one. That's the Warren Buffett type thing. Ben Graham, trying to minimize the risk of investing in companies who go bankrupt. That's the he didn't say that, but that's what he was inferring, at least in some of his writing. The other side of it, firms like Janus, 20th Century back in the day, Fidelity had a fund called the Trend Fund back in the 60s. They look at trends in stocks. So those, and oftentimes those funds are diametrically opposed. Lots of reasons for that. I won't bother you with all the details now, but that's what the website Look Out for the Bull is. I've got a kind of a multiple personality. In fact, I like to see stocks that are moving up real fast right now, but I like to see them moving up for a reason, like sales growth, or stock is just really undervalued. Those are the two. You got to have a good reason for me to buy a stock, even if it comes up on one of my trend following screens. So we're going to spend a few minutes talking about that on Thursday as well. That's the Look Out for the Bull website, which is almost ready. I know I've been saying that for a long time. I didn't realize how litigious all this stuff was getting, and how much work we had to do with some lawyers to get terms and conditions and all that kind of stuff. So I even had to bring on extra help for this. But so it's interesting. We're going to be talking about that for just a few minutes. That website, by the way, is going to be called Look Out for the Bull. It's going to be $20 a month. I'm going to post the names of stocks up there. I'll make comments when I see something that I like. I have to be very careful, by the way, because I'm buying stocks from that list. I have to let you know that before I buy. And I'm going to tell you how I set my selling rules, so you'll know that too, because those I use trailing stop orders on. So that's coming up very quickly. I think it's a lot of fun, but I've been doing this for a long time, and not going to try to sugarcoat it. Not going to tell you you're going to get rich quick. What I'm going to do is teach you the real, solid, fundamental ways of trading, which is different than investing. Investing and trading are two different things. And quite frankly, I have more of my money in the investment side of my portfolio than I do the trading side, by far. It's not even close. So which one's had the better, higher long-term returns? It's the trading side. But it's also got a lot more risk. So I'm trying to keep that risk down. And that's kind of the key with all investing, whether it's value or momentum. It's managing the risk. You've got to try and manage the risk. That's one of the things I'm not real fond about with a fund that invests in the S&P 500. The risk management there is not very good. That is not a conservative investment. That's an aggressive investment. In fact, Fidelity sent out a little thing, PDF, a couple of weeks ago. I got a copy of it, and it showed how many days that the S&P 500 had been up or down 2% in one day since the year 2000, and it compared that to the 100 years before that. And there were more days from 2000 to today, roughly 17 years, where the market was up or down 2% in a single day than there were in the entire 100-year period before it. So markets do change a little. It's generally kind of gradual, but a lot of things do stay the same. But there's some minor changes that come along. That's one of them. Short-term volatility is significantly more frequent than it was in the prior. And by the way, if you look at charts from the early 1900s of stocks in the United States, it looked like technology stocks from the late 90s. When you remember that, right? Stocks were flying and crashing. That's what the entire stock market looked like in the early 1900s. It's pretty wild. I did not expect that the first time I saw that about 25 years ago. When I saw it, I was going, wow, who was trading those? What were they doing? You had to telegraph the orders into the New York Stock Exchange. It's nuts. But anyway, so some things stay the same, some things change. Market cap weighting, here's one of my bigger problems with it. Not only are you missing the better opportunities with the smaller, medium-sized companies that are growing fast and probably going to make it into the super large companies one day, You're putting less money when they're growing faster and more money when they're growing slower. That's one thing that really kind of gets under my craw. It's not a good thing, I don't think. And if it's the only way I have to invest, then I have no choice. But if I do have a choice, I'd rather do things a little more intelligently. The other thing that is kind of crazy about this is when it goes up, and people are excited now. The market's finally broken above the levels that, new highs, new all-time highs. People are extremely excited. You've got things that are happening. The economy is growing. Actually, it had started to speed up before the election, by the way. Now it's continuing to grow. Now you got an administration that is hell-bent on reducing taxes, in increasing spending in certain areas. That will bump the economy up. It's not magic. It's like priming an engine. Same thing. You're going to prime the economy. It's going to work. If you do it responsibly, we'll get benefits for 10, 15, maybe even 20 years. If you don't do it responsibly, we get 4 or 5 more good years and another big drop. But we're right. I think we're right in a place right now. It's pretty good. Not all stocks have participated yet. That's what's really intriguing, and where I'm really excited about it, because, again, just like I said, they put more money in the bigger stocks, and here's what happens. As the S&P 500 goes up and people keep shifting money into it, guess what it does? It goes up. So it's a self-fulfilling prophecy. You keep buying it, it keeps going higher until one day it doesn't. And because of the way that it's structured, those stocks that have gone up the most are going to still get more money every time somebody invests another dollar in it. Another higher percentage is going to go into the bigger ones. A smaller percentage goes into the smaller ones. So the bigger companies are the biggest benefactors of that index. And again, these are the big companies that are not growing nearly as fast as the smaller and medium-sized companies are. So right now, you could make a pretty good argument that those super behemoths are slightly ahead of where they should be, and a lot of them are. You look at the valuation approach I'm going to teach at the seminar on Thursday night. Go to my website to learn out more about that. You look at that valuation approach, which is relatively simple, very similar to what Ben Graham taught Warren Buffett, very similar to what every private equity guy that buys businesses for a living looks at. Don't you think you should know what they're looking at so you can identify those things that they would identify? So when you're doing that and you see that, hey, a lot of these companies, they're not undervalued, and maybe the S&P 500 is not the best place to be, but as long as people keep buying it, it'll keep going up, and they are buying it, not just in America. This has been all over the world, and that particular style of investing has gotten so popular everywhere that it's actually been in the top 10% of all its categories across all markets past 5-6 years. At some point in time, that's not going to be true. At some point in time, the companies that have been ignored, the money will stop flowing into those. In fact, there might even be a slight outflow. So you can see the S&P 500 coming down, and some of the stocks that have been ignored probably going to go up. You look at what happened in the late 90s. That's exactly what happened. This is not new. This has happened many times before. What I'm saying, and I don't know exactly when the shift is going to begin, but at some point in time, I think you're going to see a big shift. And it was a huge shift coming from the year 2000 through 2003, when the S&P 500 dropped over 50%. Your value-oriented funds had 3 of their best years ever. That's why you need to be paying attention to this right now. Not only that, but value-oriented funds tend to bounce back quicker. Not all of them, but a lot of them have a tendency to bounce back quicker than the S&P 500 will after it's had a big drop. And a lot of your outperformance, by the way, on value-oriented strategies comes after the market's had a big decline. Why is that important? Well, if you don't want to have a 12-year time period with a negative return, that might help. If you're taking money out of your portfolio because you're retirement or you're getting close to retirement age, or let's say you just don't like the idea of seeing your portfolio down that much and taking that long to recover, okay, then maybe you don't want to use that strategy. Now, you're going to be going against the major institutions, the multi-trillion-dollar institutions that have most of their money invested that way, who are basically putting out the propaganda that that's the only way you should invest. No, that's the only way you should invest because you're a multi-billion-dollar manager. You have no choice. That is not in my best interest. That's in your best interests. And the stuff like that, I don't mind people who play fair, but when you omit material facts, like, yes, we're going to buy companies that have just gone up the most, and we're going to sell companies that have just gone down the most. When you omit that fact from the description of your investment philosophy, and that's exactly what you're doing, then that's not good. And anyway, getting my feathers ruffled a little bit. So, and here's the really tough part, by the way. So let's say you're not doing that, and everybody else is. In fact, the past 5 years, it's been the major recipient of most of the new money that's come into financial markets, not just in the United States, around the world. They've all been using that strategy. So, yeah, it's going to win. When that's all, when 8 out of $10 of every dollar that's coming into stocks is going into that strategy, guess what? They go up until they don't. So anyway, I think I've got to take a quick phone call here, and this is my buddy Jerry.
Good morning, William.
Hey,
I got a quick question for you.
Sure.
AAOI may be losing a little of its luster. Could you impart your wisdom as far as if it is losing its momentum, or you had given me something if it loses its value the last 50 days, if it goes below the line or what? Would you say that again? I'd like to reference that.
Well, you can use a couple different ways. If you're going to use a trailing stop on it, and you don't want to watch it every day, which is what I'm going to recommend most people do from now on, because it's just it's too hard to do anything else. You'll have a 15%. I would recommend a minimum of a 15% trailing stop. So let's take AAOI, which just it's really funny that you're saying it lost a little bit of momentum, because it's only down about 8% off of its all-time high, which was reached 4 days ago.
It was extremely volatile. There's no doubt.
Oh, they all are. All stocks are extremely volatile. But being down 8% on a stock like that over that time period, it is like well within well within normal. Okay, it's well within normal. When it did drop down, the volume was dropping on it. So there's not a lot of activity going on when the prices are moving down. So if you were to take a 15% trailing stop off the highest price, and by the way, it's one of the reasons I like to use an online broker. My favorite is Fidelity for this. There are lots of reasons for that. I'll cover more of them at the seminar. They get really upset, by the way, if somebody uses their name on their radio shows. So I have to be very careful about that, because they don't want to have to. If I make a mistake, then they might have to answer to it. So Anyway, I'll leave that there. But so the high price on that stock got up to 54. I'm sorry. Let me see what it was. It was 56.14. Mm-hmm. So 10% of 56 is 5.6. We take 5.6. That's $2.80. That's half of that. $2.80 plus 5.6. What is that? 7, 8 something. So if it comes down $8 from a little over $8 from 56, which would put you right around 48.
48. Yeah.
That would be your trailing stop. Now, if it hits that stop, by the way, that doesn't mean I don't like the stock anymore. It just means that the big momentum, the big fast run is over.
Okay.
Company comes down 15% from its high. My definition of the big fast money, it means it's probably over.
Okay.
If it comes back up on the screen, if it starts to run again, if it has a day where it's up 3% or more, hey, I got to take a real quick commercial break. Can you hang on?
Sure.
All right, thanks. You're listening to Bill Bullington right here on 1420 The Answer. I'll be back after these messages. And we're back. Jerry, you still there?
Yes, sir.
Okay, so just to kind of review a little bit, I was talking about trailing stops, and that's your best bet is to come up with an idea. And here's how this is really tough. It's human nature to want to be able to sell the top of a stock, and you just have to give up on that. And if you can't give up on that, then the chances of you being successful are pretty remote. Okay. So striving for perfection is the enemy of profitability.
Yes, I'm sure it is.
And you just have to, you've got to find a rule that you're comfortable with that does a good job of capturing a big piece of a big move and be happy with it. That's a tough thing to do.
Yes, emotionally, yeah.
Yes, it is. So trading is not an intellectual exercise. It's emotional. I can prove to you a 1,000 different ways. There are 1,000 different methods that work, and they all work well. None of them work like you want them to.
None of them are perfect. No, okay, that makes a lot of sense, Bill.
Yeah, but it's fun. I like it. Heck, I get stopped out all the time. And I don't. At this point in time, and it has been for a very long time. It's water off a duck's back.
So if I understand this correctly, you're saying that a trailing stop at 15% below the all-time high is going to be your exit point, and if it bounces back right by 3% on any specific date, it's time to get back in.
Well, as long as it stays in the top 5% of stocks over a 1, 3, or 6 month time period. So, in other words, I'm going to the stocks who are moving up the fastest over a 1 or 3, 6 month time period. So I'm taking the top 5%. They're right around 3,200 stocks that are big enough to get the attention of a mutual fund. Okay? We need that because it's the mutual funds who actually cause these things to keep running, and even exchange traded funds now. But so I want to focus on those stocks that are going up the fastest right now. And I want to make sure that in order to really pique my curiosity, they have to be going up on the day that they make the scan. They've got to be up at least 3% that day. So if they're in the top 5% and they're up 3%, there are a couple of other criteria. I'll cover that at the workshop. And that'll be covered on the website too. But they're minuscule relative to these two. They've got to be running really fast right now. And they have to be showing signs of continue to move higher. And I'll give you, I bought this stock, a few days ago. And, as soon as I bought it, it dropped the very next day. Well, now it's actually recovered. A week later, it's at a new high. The company is called The Trade Desk, and it's not a brokerage firm. It's an advertising agency. And it's an online advertising agency. And see, having had experience in that industry firsthand, I sold space in a magazine before I started doing what I do now. I sold ad space in a magazine. And so I learned we had to compete against television, radio, direct. We did direct mail, and we had the magazines. So I got to know ad agencies pretty well and how they operate. And this one is pretty cool. It's very fascinating. They're operating very similar to the way the traditional advertising agencies did, except that they're putting out their software. They teach people how to use it. When they buy, these guys arrange that if they're buying through the trade desk, that they get the agency discount. That's how they make their money. They get a discount. They get to keep the discount. So essentially, you get to use their services at a cost that would be the same for you if you went directly to the like Google and got your AdWords campaign and whatnot. And I think it's a great idea.
I'm in a related industry, so I'll check that one out this afternoon. Do you have time for
by the way,
question?
if that one drops 15% from its highest price, I'm out.
Okay, no, I'm sure you would be. Okay, well, one other question, Bill. Is there any study on the success ratio of selling calls and puts versus buying them?
None that I've seen. I'm sure somebody's done it out there somewhere, but I've never really seen that.
I got to assume that the guy or the individual who's selling them is winning a lot more times than the purchaser of them.
I would think so, especially if you're doing it on big stocks,
of course,
really
big
stocks.
Yeah.
So,
all righty. Well, I'll get off the line and wait to hear what you're talking about next.
Okay.
Have a great weekend.
Thanks. Yep, bye. And so I've got multiple personalities. The one that you just heard we were talking about trading. I like to do a lot of both, trading and investing. The seminar on Thursday is really about investing using some old school tactics that have been brought up to modern day. Very similar ideas, trying to minimize your risk. In this case, the minimizing risk comes from trying to find the companies who are generating the most cash with the least amount of debt and per dollar that you're paying for the company. And what's really interesting is the formula I've come up with. And by the way, all this stuff is, like I said, Ben Graham was writing about this kind of stuff in the 30s and the 1940s. I think the Intelligent Investor was actually first published in 1949, if memory serves me correctly. And so these are not new concepts. It's just that the accounting has changed a little bit. Not even that, in this area, it's not that much, but it's enough that if you weren't paying close attention to it, you would miss this stuff. Okay. So that's why I'm doing the workshop. Ben Graham was a quant. That's a guy who uses math. He had some formulas. Warren Buffett, Walter Schloss, and the other guys in the office, they used to sit there and go through the Moody's and the Standard & Poor's books. Those were the books that gathered all the financial data together and published it so that you could go through them fairly easily. They still had to do it by hand. So his fund was actually not that large. And he had several people working on it because they were literally going through and doing these calculations by hand. Well, today you can actually do some of them online with some screening tools. How much you spend on a screening tool is going to determine how high the quality of the data is. I'm just going to show you that. It's not that difficult. The concept itself is relatively simple. And it'll help anybody. If you like to manage money yourself, no problem. My seminars are free. There's no cost. You can come in, ask questions. I like that. In fact, I've gotten a lot of pretty good ideas over the years from some people who were pretty sophisticated, who came in and presented questions. And I went back, did some research, and it's really helped. So I think it's a lot of fun. Even if you don't learn anything, you'll probably enjoy meeting a lot of the other people that are there. Tri-Cities Corporate College, probably the best facility for this type of event in Northeast Ohio. And they've got 5-star chefs. They put out a lot of really good food there. So anyway, you go to bullingtoncapital.com to sign up online. You can call me in the office too if you'd like to, 330-664-0700. Or you can go to my website and just fill out a contact us form. Somebody will call you back if you've got questions regarding anything, actually. It's very exciting to be around at this time period when you see that there are opportunities out in the marketplace that you're always going to have risk. Managing the risk is key. Some of the older concepts still work very well. What fascinates me is there's just a thought on a formula and that wasn't explained anywhere other than I happened to be sleeping, and I woke up and I went, "Hey, wait a minute." That's when you know you're probably spending too much time looking at financial statements, or talking about it or thinking about it. Unless it's what you like to do, which is what I'm doing. So most people don't have the kind of time to do that, nor do they have really the interest. But it's really important that you understand the basic concepts of how you're investing. If more people understood the concept of the market cap weighted or market value weighted strategy, like the S&P 500, I'm pretty sure they would find other ways of investing, or at least they would include some other funds or strategies in their portfolio. Because that is, who wants to go through a 10-year period and not make any return or be negative? And that's what's really kind of spooky, because you've got a lot of millennials just coming of age, just starting to invest in their 401k plans. and don't know any better. And they don't know any better because the big institutions that are raising the most money right now, that's their methodology. That's what they're using. The robo-brokers, that's what they're using. And it's a very painful way to find out, to watch your portfolio drop by 50% when you didn't expect it, because the people that are selling the service are not mentioning that fact. They're not even telling you how they're managing the money. And you're going to get upset. And they're going to scare off an entire generation of investors from the stock market. And that's the upsetting part, because I got news for you guys. You don't have another choice. If you don't own a business and you're not willing to build a business and take a lot of risk that way, or if you're not lucky enough to be a Fortune 500 executive, then you're going to have to invest in stocks if you hope to build a net worth that allows you to retire one day. You don't have a choice. You're going to have to do that. And I know I'll get people taking issue with that. That's okay. This is America. You're free to, feel free to dispute whatever you'd like. Call in, we'll debate. But I'm just telling you, you will find out. The truth doesn't need defending. You're going to have to learn how to invest in stocks if you hope to accumulate enough in money to be able to retire one day. For those of you that are close to retirement, you're going to have to invest in stocks if you hope to maintain your lifestyle. And I've only got 30. Oh, there's the music. I'll have to pick this conversation up next Saturday morning at 11. Hey, thanks for listening, everybody. This is Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. Have a good week, good luck, and good investing.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.